Have you ever heard the saying, "Don't put all your eggs in one basket"? It's age-old wisdom, and it holds incredibly true when it comes to your hard-earned money. What if I told you there's a strategy that can help you weather market storms and come out stronger? It's called investment diversification, and it's the secret ingredient to building a resilient and profitable portfolio. Imagine this. You've invested all your savings in a single company, and suddenly, an unexpected event sends its stock plummeting. It's a nightmare scenario that keeps many investors up at night. But what if you had spread your investments across different companies, industries, even different parts of the world? Suddenly, that single event wouldn't have such a devastating impact. That's the power of diversification in a nutshell. By strategically spreading your investments, you're essentially creating a safety net for your portfolio. If one investment takes a hit, others can cushion the blow, keeping you on track to reach your financial goals. In this video, we're going to break down the ins and outs of investment diversification, giving you the knowledge and tools you need to build a portfolio that can weather any storm. We'll explore different diversification strategies, common pitfalls to avoid, and real-world examples to solidify your understanding. Let's break down this concept of diversification a little further. Imagine your investment portfolio is like a basketball team. You wouldn't want a team composed entirely of point guards, would you? You'd need a mix of players with different skills, centers, forwards, guards, each bringing their strengths to the game. Investment diversification operates on the same principle. Instead of putting all your money into one company, industry, or asset class, you spread it out just like assembling a well-rounded basketball team. This strategy helps to mitigate risk because if one investment underperforms, others can pick up the slack. Think of it this way. If you invest solely in technology stocks and the tech sector experiences a downturn, your entire portfolio takes a hit. However, if you've diversified your investments to include other sectors like healthcare, energy, or real estate, the impact of a tech downturn on your overall portfolio is significantly reduced. Diversification is essentially about not putting all your eggs in one basket. It's about strategically allocating your investments across a range of assets to create a more resilient and balanced portfolio that can withstand market fluctuations. In the next section, we'll dive deeper into the compelling reasons why diversification is paramount for every investor. So, we've demystified diversification, but why is it so crucial for your financial well-being? Imagine this. You're on a roller coaster, and it's a thrilling ride with its ups and downs. Now, wouldn't you prefer a smoother ride with less drastic drops? That's precisely what diversification does for your investments. Diversification acts as a shock absorber for your portfolio. When one investment takes a hit, others can cushion the blow, preventing a single event from derailing your long-term financial goals. By spreading your investments, you're essentially reducing the impact of volatility on your overall returns. Let's look at a real-world example. Remember the dot-com bubble burst in the early 2000s? Investors who had poured all their money into technology stocks experienced significant losses. However, those who had diversified their portfolios across other sectors fared much better, as those sectors weren't as severely impacted. The beauty of diversification is that it doesn't require you to predict the future. You don't need to know which sector will outperform or which stock will skyrocket. Instead, you're strategically positioning yourself to weather any storm by spreading your risk across a range of investments. In the next section, we'll delve into some effective strategies to implement diversification in your portfolio. One of the foundational strategies for effective diversification is mastering asset allocation. Asset allocation involves dividing your investment portfolio among different asset categories, such as stocks, bonds, and real estate. This strategy is akin to creating a balanced diet for your finances, ensuring you get a mix of different nutrients to stay healthy. For instance, stocks are known for their high growth potential, but come with higher risks. Bonds, on the other hand, offer more stability and lower returns. Real estate estate can provide both steady income and potential for appreciation. By combining these assets, you can create a portfolio that balances risk and reward. A classic example is the 60-40 portfolio, where 60% of your investments are in stocks and 40% in bonds. This mix has historically provided a good balance, offering growth potential while mitigating risk. However, the right allocation for you depends on your financial goals, risk tolerance, and investment horizon. Younger investors might favor a higher percentage in stocks, while those nearing retirement might lean more towards bonds. Regularly rebalancing your portfolio is also crucial. Over time, the value of your assets will shift, potentially skewing your original allocation. By periodically reviewing and adjusting your portfolio, you can maintain your desired risk level and optimize your returns. Beyond asset allocation, another powerful diversification tactic is geographic and sector diversification. This strategy involves spreading your investments across different regions and industries to mitigate the risk associated with economic downturns or specific sector declines. Geographic diversification means investing in markets outside your home country. For example, if you're primarily invested in US stocks, consider adding international stocks from Europe, Asia, or emerging markets. This approach allows you to capitalize on growth opportunities in other regions and reduces the impact of any one country's economic troubles on your portfolio. Sector diversification, on the other hand, involves spreading investments across various industries. Instead of putting all your money into technology stocks, diversify into healthcare, finance, consumer goods, and energy sectors. Each sector has its own growth cycles and risks, so diversifying helps smooth out returns and ensures that you're not overly exposed to a single industry's downturn. An excellent example is the global financial crisis of 2008. While financial stocks plummeted, healthcare and consumer staple sectors remained relatively stable. Investors with diversified portfolios across various sectors experienced fewer losses compared to those heavily concentrated in finance. By incorporating geographic and sector diversification, you create a more resilient portfolio capable of withstanding global economic shifts and industry-specific challenges. This strategy not only enhances potential returns, but also provides a safety net against market volatility. While diversification is a powerful tool for building a resilient portfolio, it's not without its potential pitfalls. One common mistake is over-diversification. It might seem counterintuitive, but spreading your investments too thin can actually hinder your returns. Imagine owning tiny fractions of hundreds of stocks. It becomes difficult to track, manage, and benefit significantly from any one investment's growth. Another pitfall is misunderstanding correlation. Just because you've invested in different assets or sectors doesn't automatically guarantee diversification. For instance, if you own stocks in a luxury car manufacturer and a high-end fashion brand, their performance might be correlated. They both tend to do well during economic booms and suffer during downturns. True diversification involves understanding the relationships between your investments and ensuring they don't all move in lockstep. Perhaps the most significant pitfall is emotional investing. Fear and greed can drive investors to make irrational decisions, even when they understand the importance of diversification. During market downturns, fear might compel investors to sell diversified holdings at a loss, locking in those losses. Conversely, during bull markets, greed might lead to overconcentration in a particular sector or stock that seems to be skyrocketing, neglecting diversification principles. Navigating these pitfalls requires a disciplined and informed approach. Regularly review your portfolio, not just its performance, but also the correlation between your investments. Ensure you're genuinely diversified across uncorrelated assets and sectors. And most importantly, don't let emotions dictate your investment decisions. Stick to your long-term strategy, ride out market fluctuations, and remember that diversification is a marathon, not a sprint. Building a well-diversified portfolio is an ongoing process, not a one-time event. It requires regular attention and adjustments to ensure it remains aligned with your financial goals, risk tolerance, and market conditions. Think of it like tending to a garden. You need to water, fertilize, and prune to keep it thriving. One crucial aspect of maintaining your portfolio is periodic rebalancing. As market values fluctuate, your initial asset allocation can drift, exposing you to higher or lower risk than intended. Rebalancing involves selling a portion of overperforming assets and reinvesting those proceeds into underperforming ones to restore your target allocation. This disciplined approach helps you buy low and sell high, potentially enhancing your returns over time. Another essential practice is reviewing your investment choices. The market landscape is constantly evolving, with new sectors emerging and existing ones transforming. Periodically assess if your current investments still align with your long-term goals and risk appetite. Are there new industries or asset classes worth considering? Have any of your holdings become too correlated? Regularly reviewing and adjusting your portfolio ensures it remains dynamic and aligned with your evolving needs. Finally, don't underestimate the power of staying informed. Keep abreast of market trends, economic indicators, and geopolitical events that can impact your investments. Subscribe to reputable financial publications, listen to podcasts, or consult with a financial advisor to stay informed and make well-grounded decisions about your portfolio. Remember, maintaining a well-diversified portfolio is an ongoing journey, not a destination. Embrace a proactive approach, stay informed, and be prepared to adapt your strategy as needed. By doing so, you'll be well-positioned to navigate market fluctuations and achieve your long-term financial goals. As we've explored throughout this video, diversification is not about eliminating risk entirely, it's about managing it intelligently. Just as you wouldn't rely on a single ingredient for a delicious and nutritious meal, your investment portfolio thrives on a balanced mix of assets and strategies. By diversifying across different asset classes, sectors, and geographies, you create a resilient portfolio capable of weathering market storms and delivering more consistent returns over time. Remember, diversification is a marathon, not a sprint. It's about staying disciplined, avoiding common pitfalls, and continually adapting your strategy to align with your evolving financial goals. While diversification doesn't guarantee profits or eliminate losses, it significantly reduces the impact of any single investment's performance on your overall portfolio. This approach allows you to sleep soundly at night, knowing that your financial future is built on a solid foundation of well-diversified assets. In the ever-changing world of investing, diversification remains a timeless principle for building wealth and achieving financial security. So, embrace the power of diversification and watch your investments flourish with greater stability and resilience. Now that you understand the power of diversification, it's time to take action. Don't let your hard-earned money sit idle or be exposed to unnecessary risk. Start building your own diversified portfolio today. Take a close look at your current investments. Are they overly concentrated in one stock, sector, or asset class? If so, it's time to explore diversification strategies and rebalance your holdings to create a more resilient portfolio. Remember, knowledge is power when it comes to investing. Subscribe to our channel for more insightful financial advice, tips, and strategies to help you make informed decisions about your money. And don't forget to hit the like button if you found this video helpful. Share this video with your friends, family, and anyone who wants to take control of their financial future. Let's spread the word about the importance of diversification and empower others to build a brighter financial tomorrow. This video is for informational purposes only and does not constitute financial advice. Please consult a qualified financial professional before making any investment decisions. Your financial situation is unique, and only a licensed advisor can provide guidance tailored to your individual needs. Thank you for watching.